Morning, I'm Daryl Jones, Director of Research at Hedgeye. Welcome to the Macro Show for November 24th, 2025, Thanksgiving week. Thanks for joining us. A lot to get into this morning.
Get a little free one today.
Yep, freebie.
That's a nice hat.
Thank
I
you.
like that. You know, that's the kind of thing that we like, are nice hats here.
Yep.
We're not allowed to talk about the tickers. So again, the Hedgeye Asset Management has indeed launched, hedgeyeam.com. We actually launched a new ETF on Friday.
Yep.
But we shall not disclose the tickers. All right, top three things this morning. Again, welcome to those of you that are new to us in our community and what we're doing here. What we do every single day, because we're very consistent and disciplined Bayesian boys, Jonesy, Buds, and I, and the macro team. Again, we give you the top three things that are in the notebook. But again, that's the summary of all things. So it's all of global macro, 50 different countries across currencies, commodities, fixed income markets, and stocks, so that we don't get caught really holding the bag on narratives. Yeah, we don't do narratives, we do numbers. And then, of course, narratives are born out of numbers after they occur, and that's how we roll. So again, we're not trying to tell you a story. That's what the human mind wants and needs to hear, but that's not how risk management and generating alpha works. Top three things this morning include the bond market, oil, and the VIX. First, on the bond market, I mean, here's a good example if you're new this morning. I mean, the time to buy bonds is when I put it in the title of the early look, like buying bonds. Okay, so again, that's pretty straightforward in as much as giving you quad 4 for the fifth straight day actually, in terms of how many days I've written the early look. That's my morning strategy note that I spend between usually 6 and 6:45 in the morning publishing. So again, today it was quad 4 versus the stress that you could have if you were not set up for that. There's no stress whatsoever if you're long bonds. So again, today's another quad 4 day for bonds. And if the Fed agrees with it, and that's why people get excited about the U.S. equity futures, and that's what they're told, and they should be careful what they're wishing for, because a quad 4 is of course a growth slowing economy. So again, you got that. Bond yields are down over 10 basis points now versus where that arrow again told you that we're making another lower cycle high. Bond yields across the curve, 2s, 10s, and 30s. I publish the risk ranges every single day. Are signaling lower highs within bearish trends for bond yields, which are bullish trends for the bonds. We're long BBN, which is municipal bonds. We're long LQD, which is investment grade bonds. We're long TLT, which is, of course, longer term treasury bonds. Point number two, the number one driver of inflation slowing into the quad 4. So again, guys, if you want to show the spaghetti map with our quads, quad 4 is when you have the rates of change of both growth and inflation slowing at the same time. So that's where we're at from a monthly quad perspective for the month of December. You guys can pop the monthly quads there. I think it's slide 27 for people to see that there's only one 4 to risk manage, which, by the way, if it goes away, I'll just go the other way, because that's what I do. I go both ways. Right? So you got that, but oil is a hugely negative contributor to inflation. It's the number one weight in our league-leading inflation nowcast that the street pays us for. We advise trillions in assets under management on the institutional side. We're building our own asset management business, but again, I digress. What we have there is a very obvious signal with oil down 24% since June. It is listed every day as bearish trend and has been for quite some time. So again, eventually that's going to be positive for the quad 1 that we get to, because quad 4 and quad 1 have one thing in common, which is the rate of change of inflation is slowing. So again, that will eventually be good for the U.S. consumer and those consumers who need a break, those consumers who don't have any money left, those many consumers, sadly and unfortunately, continue to struggle with elevated levels of inflation. What we're talking about not is inflation going away. That would be absurd. That would sound like I could be on MSNBC or something like that, when it was a different president, and now obviously on Fox with this president, because they're all just bullshitting you, looking for clickbait. But all we're talking about is that quad 4 and quad 1. The next 3 months, December, January, and February are all disinflation quads, don't forget, which again, oil would confirm, cocoa prices would confirm. Did I say cocoa? Oh yeah, I did say cocoa. Not like Cocoa Puffs, like cocoa, like the number one input to chocolate, like that's down 37, what is it, down 37% in the last 3 months, 39% for that matter. I go through all that in the early look, the things that are moving on a week over week basis. So again, after they go up and down, you don't get talking points from somebody else about what already you would have already known if you're subscribed to Hedgeye. Finally, on the VIX, there are 3 buckets of volatility according to me. 1, the investable bucket when the VIX is below 19. 2, the chop bucket, again, when you're between 19 and 29 on the VIX. And 3, which is really 3, the fuck bucket, which is, again, that's when the VIX is north of 30 and people get killed. Now, you would have seen that last week, actually, in the NASDAQ, because the equivalent of the VIX is called the VIXN, okay, the VXN. That got up 32, 33-ish. Yeah, it pulled back on Friday on the Williams, oh, they're going to cut in December. No shit, Sherlock comments. But again, that doesn't change it. You have quad 4 conditions. So again, the number 1 indicator that would get me to start buying things that I would buy for quad 1 would be the volatility of volatility. So that needs to break down, below 19 and hold below it. The low end of the risk range isn't even there this morning, so that's at 19.87. So very specifically, the low end of the range doesn't even get you out of the chop bucket. Here's the thing about the chop bucket. When people are panicking, you buy and cover. When people are, again, chasing, you sell and short. That's what we're going to do today if the market opens where the futures are indicated. Again, do not trade where the futures are indicated, ever, okay? Or even in the first 20 minutes of trading, for that matter. I call that the kiddie pool for a very specific reason. That's where very bad decisions are made. Let the water settle, come on in there and execute on the process between 9:50 a.m. and maybe 11 a.m. and then we will again come back in real-time alerts and help you risk manage the close. If something changes, you'll see it in your real-time alerts saying, hey, this has changed, the risk range has changed. On the S&P 500, the volatility regime has changed. Currently, there is no change, all right? You still have a volatility regime of chop bucket. You still have negative gamma, which I'll review momentarily, which is, again, the Tier 1 alpha data that we also try to make you very readily aware of every single morning. And the flows are also negative, don't forget. And those are your top 3 things, right? I also try to highlight a book, every morning. I try to read a book every 10 days. Today, I went back to the wood, right, Jonesy? Yep. Here's a great book, right? Think about your current life. If you're just watching this for free today, I don't know when you get up in the morning or what you listen to. I don't particularly care. Again, you shouldn't care is the point. It's your life, right? Like, why are you wasting precious life and cycle time? Unless you're political, I get it. You need to get the talking points from the left or from the right. But, from a market's perspective, it's complete bullshit that you're listening to. It's absolute clickbait. There's no process. There's no risk management, okay? If they want to keep doing that and they remain on the other side of all of our trades, let them, right? Let them do that. There's so many things in this good life to look forward to. And again, managing stress. How about that? There's a good chapter in here. Mel gets a good following for good reason. You can't control how other adults behave. Think about this over Thanksgiving and how much you have to be thankful for. Get rid of the people in your life and the things certainly in your process that are getting in the way of you leading some kind of the life that you should be able to live, being all stressed out all the time. Let those adults behave and stress out about whatever it is that they need to. You'll never reach your full potential of your life if you continue to allow stupid things or rude people to drain your life force. Very accurate, right? Think about some hockey parents we have to deal with.
Yeah, very true.
How do you get them out of your life? You're a single guy, so you can just kind of move on to the next.
Move on to the next, yeah. I guess that's how it works.
Jonesy's going deep here this morning on that. I didn't mean to pry, Jonesy. 64.76. Every single day we have a risk range for the S&P 500. I typically write it down just to reinforce good behavior. Again, so when you look at a market, what do you see? A 50-day moving monkey chart? An astrologist commenting on it? What are you looking at? What we see are fractal patterns, okay? Fractal math, fractal patterns, this is called a fractal dimension. Now, we call it the risk range so that people can wrap their heads around, okay, here's the upside in the range and here's the downside. But again, what it really is mathematically in terms of its calculation is a fractal dimension. So what this is doing now is quad 4 things. It's signaling lower highs and lower lows. The all-time closing high for the S&P 500 is 68.90, and yes, we were long lots of U.S. growth equities, beta, et cetera, going into that multiple times, all-time highs in October. October was a quad 1. As you go back to that monthly quad map, you saw it. So you're well off this. Currently, you're minus 4% from that, and you only have plus 1.7%, of upside versus Friday's close. So the S&P 500 could be up 1.7% today, and I wouldn't be surprised. I mean, it doesn't mean it has to be up 1.7%. In fact, the probability is not high that it will be, but it could be, right? It's not like a outlier, right? And in as much as it can turn tail intraday and end up being down 1.9%. So I call that a fair fight. I mean, after the market goes down for 4 straight days, it was down for 5 out of 6, the market's going to bounce, especially if volatility is coming off a very high level. So that's the way that it works. What typically happens after the bounce or during the bounce, all those weak-handed chasers, they start chasing again, and then they'll chase into another lower high that you sell into. We got a whole bunch of shorts to put on here. I only have 4 on in real-time alerts. I could have 24. So again, there's a lot to do, a lot to think about, but please do not chase alongside the crowd. When you look at a screen, if you are getting excited, greedy, you're just anything positive when the color is green, right? Similarly, don't get freaked out when it's red, right? Now your amygdala is going to trigger that more so than the green. Had some people really get into the whole, 2/3 of the receptors in your eye are going to be recognizing red more readily.
That's interesting.
Right? And stop signs, CCM in red, Jonesy.
Jumps out at you.
We're investors in that company. That's why we wanted that to pop for a little bit. Now we can't talk about the tickers, but we can talk about the CCM. That's not a ticker.
Nope.
Private
company.
We would know. We own part of it, right? So there you go. So just think it through. If you're feeling, it's really positive when the color's green, we're going to fade you, right? It's called being the informed volume versus the uninformed volume. The uninformed volume bought NVIDIA at $195 when we were telling our subscribers to sell it last week on the open. And if you don't believe that because you don't want to or need to, it doesn't mean it didn't happen, right? In fact, that's probably why some of you are here today. What a great call, right? If you're looking for some dude on Wall Street, in particular the guys, because there's mostly guys that do this, you're looking for the wrong thing. I'm not Nostradamus. Don't look to me to make calls on markets. If that's what you need as some guru, I'm not your guy, right? I'm just a mucker who's going to execute on the process. What you need is a process that is repeatable, consistent, disciplined that you can execute on. Calls are just born out of that. Calls are what Wall Street brokers call them because that's what they're calling to action so that you execute, in the old Wall days, and give them a big brokered commission on that. So again, we're not making calls. We're giving you the confidence to execute in a process, embrace uncertainty at its core, and read and react accordingly, all right? So there you go. What else we got going on for you this morning? Friday was options expiration, so volume was up. Not a huge amount, but it was definitely up. It is the holiday shortened week, so you'll see all this poppycock on MSN or whatever, MSM type media. Well, in a holiday shortened week, the market's going to go. Whatever. I mean, it doesn't matter. Let them. If they need to believe or think about those narratives, you can do so. But again, just sell some nearing the top end of the risk ranges and buy some and or cover some shorts at the low end of the range as I outlined. Sectors, winner, chicken dinner. Friday everything was up because everything was down before that. I do highlight our number one sector style position that we have. So don't tell me that we didn't make money on Friday because we're long healthcare. That's the best sector style pivot I think I've ever made in healthcare, certainly in healthcare, because we were short healthcare at the beginning of the year. We stayed short all the way through August. Then we got out of the short and then flipped to the long side. So that's called a sector pivot, a sector style pivot that is quad compliant. So again, when you're going into quad 4, healthcare is one of the top sectors that you can own. And of course, and evidently that's done quite well. It's already up over 7% for the month of, you go back to that table where it says month to date. I'm not big on year to date because I don't do year to date. I do cycle to date. So for quad 4 cycle to date, look at healthcare is up 7.18 versus tech down 9.14 and consumer down 6. We're not long XLK or XLY, we're long XLV. So again, long gone are the days, or he's bullish, or he's bearish, or he's a perma bear, or well, it is true that Telecom Tom Lee is a perma bull, but again, what we do is we're constantly and permanently risk managing and pivoting. We do not care if we're long or short something. They're just tickers to us. So again, if you get the sectors right, you tend to get a lot of stock picks right, by the way, and we do have a lot of If you look at our signal strength longs, which Jonesy will probably ask about, more and more healthcare names are popping onto that list. That is also a product that you can buy as a standalone or part of the entirety of the process, which I would highly recommend being integrated into the entirety of the process. Tier 1 out, actually cross asset class vol, no change on the move index. Remember when, excuse me, remember when Fed rate cut expectations on this day last week, Jonesy, were like 30%?
Yeah.
Now they're like 70%. So the move index went up. There was some volatility associated with that because we have, again, trillions in assets under management are using our inflation nowcast, our risk range signals on bond yields to invest. We have some of the biggest bond traders and CIOs and PMs in the world, right? So they're sitting there like, well, that shouldn't be that. So you're going to get some volatility when the Fed minutes implied that there was a lower probability of a Fed cut. If you're going with the Fed minutes, there are macro tourists, and then there's that. I mean, that's maybe your first time outside of your home. I don't know. But don't do that, right? So again, as Fed rate cut expectations went up, the volatility of the bond market, or the MOVE index, which is the equivalent of the VIX for treasuries, came down. So that's quite bullish for treasuries and was into the end of last week. I already pointed out what else we're long. There is still credit risk that is reappearing. So if you look at the 10-year triple B spread, which is maybe a little too much for people that want to look at moving monkeys. Monkeys are nice. I like monkeys. But I just wouldn't use them to manage risk, and I'd fade them. You should fade them. I mean, this is not to be faded. As this continues to make higher highs and higher lows and heads towards like a buck or 100 basis points over, that will be an ongoing risk signal of the many quad 4 risk signals that we've already reviewed and that we already have. So again, that is very much unlike October when I told you that was going to fade. And it did, okay? We bought every damn dip in stocks in May, basically May through October, and that stopped here in November, and we started to respect, of course, didn't start to respect the market. We respected the changing signal from the market, which is a much more important way to put it. What else we got going on for you? Tier 1 alpha data, gamma. So again, where's gamma? Where is the throttle for gamma? If you don't know what those things are, I don't have time to explain them again this morning, but they're negative, okay? So negative doesn't mean you go down. It means that the up moves and the down moves happen faster. So that's why the futures move like they did on Friday. See that big intraday sell-off actually into the close too? And on the open, they'll gap up and then gap down faster. That's because gamma is negative, okay? That's what we have to say about that. If you want to read the entirety of the Tier 1 Alpha report and pay for it, you should, okay? I don't have time to go through it beyond that. What else do we got going on for you this morning? Short-term calendar vol is pretty elevated at 25. It got up to 32 last week. Could it go lower? Maybe. It doesn't have much of anything but flatness in that curve towards 23. So I put an I don't know on that. What I do know is that 1 month realized volatility is still below. So or 1 month realized volatility, the blue line is still above the red line. The red line is below the blue line. Why does that matter? Because that triggers systematic or volatility control fund selling, CTA selling, systematic selling. We've seen that. You can show the CTA chart from last week. It got absolutely crushed, which is one of the many reasons. I mean, the biggest reason to be bearish on this market, the biggest bubble that exists, isn't the one that everybody talks about on CNBC every day. It's in market structure. Yeah, it's in short-term levered options, the behavior of the herd, the systematics that are dealing inside of that, the pod shops that are trying to generate alpha on that. That's the mother of all bubbles. We've never seen a shorter-term market in the history of markets. Okay, with short-term options being the definitive component of leverage. If you want to go find like some super cool private equity risk story, Jonesy Buds and I can go buy you a steak too and get you some steak knives alongside that. That's not going to generate alpha. This will, okay? And see how that blue line came down like a hot mess, and we were out of the way, obviously, before that happened. Asia last night, Japan was closed. China was not up, and it's another big thing. So again, when you look at a market, what do you see? Oh, I see the futures. I'm feeling it. Whatever you need to do. Right? What I saw was there was no follow-through in London, South Korea, China, to USA's up 1. Yeah, S&P ended up closing, it was up higher intraday, but ended up closing up 1% on Friday, and these markets didn't care. I mean, South Korea, which has been a go-go market, was down last night and is a medium-term trade bearish now, don't forget. And yes, I'd short the Philippines, EPHE, up here at the top end of the risk range. Europe, we're still net short that. We have no European longs. We're short their currency. The euro, which was down another % last week. all of our currency trades have been great. We're long the dollar, of course, for none of the reasons that most people that are still short of it on the debasement theory or narrative or whatever they need to believe. These people don't understand, evidently, a place called Europe or Japan. So again, or the UK for that matter, which is also showing economic growth slowing or stagflation. So again, all these currencies are bearish trend. You can see that in the early look. You can see it in the risk range product. We're also short my homeland's currency, Jonesy Buds 2, in the Canadian dollar. Just FYI on that. Commodities, we've said our piece. Gold's not a commodity, it's a currency. That's up again this morning. It's up, in the last month, really you've not had a panic attack in silver and gold. They're up, right? Whereas in the last month, something like Spy Monkey, which we don't have a position in, is down 2%. NASDAQ's worse than that, it's down 3%. So again, one of the biggest things that we do is we go anywhere with our portfolio. It's diversified. One of the biggest reasons why you see NBC types and welcome, or retail investors, yes, that's an insult. You're not, our individual investors are not retail investors. They are self-directed, in many cases wealthy, and or family office accounts that understand that if you could go anywhere, you would. The reason why the CNBC types don't is because they don't have a process to do so, and there's no advertising dollars really in silver. You notice that? Right, or in bonds, like come on. Muni bonds, BBN, no, we're the axe in muni bonds. What else we got going on for you this morning? Corn is back to bullish trend and held last week despite some corrections. A lot of quad 4 action, as I said, in commodities. We're also short lumber. The ETF on that is wood. Lumber price is down 12% in the last month as well. Bond yield set on that across the board. You should notice the risk range is pretty tight, but again, lower highs. So the equivalent of this is 402 to 415. This would have to get greater than 4.26 to change the trend. Okay, so again, if you don't know where all these lines are, be rest assured that I do and will act accordingly. I'm the only person who will give you all this information that is born out of my team and all our hard work. This is humanly impossible for one person to do. So if you're looking for a call out of somebody who's a one-man band, good luck with that. I could never do that. I certainly would have no integrity to ask you for compensation for that. So again, the integrity is in the process. Again, it's in understanding, that I know what to do with this and that I'm the only person showing you ultimately my portfolio. So through Macro Pro or Portfolio Solutions, you can see every one of my long-only positions. I think I have 22 or 23 of those currently, 21 actually, as of Friday, and that's at a good spot. We're still short Bitcoin.
I was going to ask about crypto to start. We didn't really get into too much detail.
Terrible looking thing. I mean, Bitcoin's down again this morning. Again, of all the disconfirming evidence of U.S. equity futures, just write down 3 of them. Oil, actually write down 4. Oil, bond yields, South Korean Kospi, and Bitcoin. And what else do you need to see? I mean, this is the point about looking at taking, you don't even have to understand fractal math. Actually, you can now. Just use ChatGPT, say, can you explain this to a 2-year-old? Right? And what it's going to tell you is that you, the human, cannot understand or see what the fractal lens can see when it looks at markets. When it's looking at it, it's looking at everything. Everything at the lowest level, at the smallest scale, and at the largest scale in a fractal is self-similar. Okay? So in this case, it's the self-similarity, Jonesy, is quad 4.
Yep.
From lumber prices, like, again, we think of Bitcoin, we don't think of it, it's not like some theory. It's due to the volatility attributes of the asset class and of Bitcoin itself. Bitcoin and crypto we think of as commodities. These aren't currencies. They're commodities with very high betas, very high volatility levels that are continuing to collapse here. Bitcoin, inclusive of this morning's decline, down 32% from where it peaked in quad 1 when we were long it in October.
Yep. Okay, yeah, I wanted to ask about longs and shorts because you did mention on the call, I think it's now 80-some longs, 50-some shorts.
81 shorts.
Sorry, 81 shorts and 50-some longs. So it's really tipped toward the short side. Healthcare is entering on the longs, but anything else to be noted?
Yeah,
the stocks?
You should always note the tilt, right? So this used to be, when quad 1 and quad 2 earlier this year when we were buying every damn dip, this number was closer to 100. It's basically been cut in half, right? This number was closer to shorts, signal strength shorts. What are signal strength longs and shorts? The analyst has a view on it, my signal confirms. If you could have both, you would. If you could have a fractal god tell you that analyst is going to be right over here and wrong over there, you would go with it. So 81 different stocks are currently confirmed on the short side at Hedgeye. That's a lot, right? That's like a 2 or 3 bagger over where we were when volatility was in the investable bucket, when the VIX was below 19. And to Jonesy's point, what's happening in this investable bucket, or in the chop bucket rather, is that we're seeing names that are both healthcare, like names like, here you got names, shouldn't be red, this should be green. You got names that are falling into this like DGX, Cardinal Health, WGS, some growth in there. But you're also seeing some cyclicals, right? Like we've got like FedEx in there, PACCAR we reviewed this morning on the call. These are some early cycle cyclicals that quite like the idea of making a quad transition from quad 4 to quad 1 with falling oil prices. Is that a lot to like kind of wrap around your fractal skull if you don't have it yet? Oh yeah. But that's how we pick stocks. We don't sit here like Captain Stock Picker. And by the way, Captain Stock Picker, for all you that get annoyed and in some cases insulted, he's talking about my technical ability with my 50-day moving average. I used every stupid thing you've ever used, believe me, all right? And I don't use it if it doesn't work. So if you use a 50-day moving average with a valuation model to start, we're gonna like beat you like a Reddit mule. Like you're gonna get smoked over time, right? That's what I mean by Captain Stock Picker, my former self. So I found that it's better to market it that way because now I'm criticizing myself instead of you, when really you need a coach. You need somebody to say, McFly, like what are you doing? You love AI over here, but you're still using like single factor moving averages? Like what are you doing? Static valuation multiples? Okay, that's a lot to answer your question.
So I did want to go back to I think it's the tier 1 chart that shows the calendar with volatility. Because we do have some economic data this week, although
finally.
I think it is actually maybe more September data, but how to kind of think through this. Oh, they don't even, okay, well, we're actually getting September retail sales this week. I guess they don't have it on there. But again, old data point, so maybe it doesn't matter.
I don't think that anything really matters until you get to this number here. This is the non-farm payroll number, right? We're finally going to get the second. The last one that they released last week was like meh, because that's going to drive up or down the odds of the Fed cut.
Yeah.
As we go, Jonesy, throughout December, we are going to, again, if you don't think that at some point I'm going to be like outright quad 1 bullish, you got another thing coming. Now, the mistake most people will make, because they want somebody to make a call, right? Like you're like, I can't afford Hedgeye because I live in a van down by the river. Like if you can't afford the macro show, like we're probably not for you. That's not very expensive. Given the amount of empowerment we're going to give you, we're going to change your life. I mean, come on. If you can't understand that there's a positive that you could consider over here and be positioned risk managedly and properly positioned negatively before that happens, we're going to have a hard time. Why do humans really want the alternative? Because it's easier. Right? Everybody wants a shortcut. People are lazy. There's an 8-second attention span in America right now for people like when they even look at their Instagram or TikTok. Right? We're spending tons and tons and tons of time to help you simplify the complex here. So here, Jonesy, I think that that's just going to be more or less an event or not. For the bond market, and we're going to have to see how people have the read-through in the stock market. We know Wall Street's catalyst after things go down is that they want the Fed to go dovish. And that's really not fundamental. That's just kind of what's put us in the position that we are. Like on the one hand, you can't complain about the economy having so many people with no money and the K-shaped economy we have. Like we're all getting richer and they're all getting poorer. And not blame the Fed for that, or Wall Street begging the Fed for more easy money policy. I mean, it's ridiculous. So, we don't talk out of both sides of our mouth on things like that either.
All right, we're going to wrap it up there. Coming in on 9:30. Thanks everybody for tuning in. Back at it tomorrow at 9 a.m. Take care.